Well, for more on the currency battle, I'm joined now by the head of market analysis at Schneider Foreign Exchange, Stephen Gallo. Stephen, good to see you again. So, ongoing frustration in Washington that China's currency is really appreciating too slowly. Could China be showing more flexibility with its exchange rate?
Well, it already has done so, and I think to a large degree what we're seeing is China starting to respond a little bit to the international political climate, which wants obviously to move in a positive direction with its currency. It wants a revaluation. But this is really, I mean, we're getting into a sphere here where politics are playing a very key role in foreign exchange, and I think this is why foreign exchange really, at the end of the day, is the coolest asset class, because once you move away from the fundamentals, the only thing left is the political sphere. And this is not only about Washington and Beijing, it's about Washington, Beijing, and now Tokyo as well. Because don't kid yourself, the move that the Japanese did following the results of the DPJ election are entirely in line with, or entirely to do with, what the Chinese have been doing in terms of buying JGBs.
So you concur with that argument that it was as much of a response to the yuan to China as it was to the US?
Yeah, absolutely. You know, if the first half of the year was about the Eurozone's problem and the sovereign debt crisis in Europe, it seems to me that we're moving into a sphere where politics and devaluation, every man's devaluation, because don't forget, all economies at the moment within the OECD space would prefer to have as weak a currency as possible. It's not just about the Japanese and them wanting a weak yen. Washington wants a weak dollar. The Eurozone wants a weak euro. The UK wants a weak pound.
And this is the problem, right? It raises questions about how effective unilateral intervention can be.
Well, I think the comments that we've seen from Juncker already, they sort of echo the same sort of comments that we saw from the Europeans when Japan was involved in the first, in its last devaluation of the yen in 2003 to 2004. I think the Europeans would much prefer that they had multilateral intervention to try and control the yen, not unilateral. But at the end of the day, it's politics that are playing the key role here. And when you consider the fact that we are probably going to be heading into a holding pattern as far as monetary tightening cycles are concerned, and we're going to probably see more stimulus efforts from central banks in the OECD space, devaluation is going to be not something that we're just seeing from the Japanese. It's going to be something that we're going to see a desire out of Washington, a desire out of London,
exactly.
A desire out of Berlin.
Prospects of, we've been speaking about the Fed possibly, stepping up their purchase of bonds. How's that going to affect the U.S. currency?
Well, I mean, probably the second round of quantitative easing, whenever it comes and whatever form it comes in, it probably will not weaken the dollar as much as the first round of it did, simply because you don't have as much capital to fly into riskier assets as you did back then. Remember, all that pent-up capital and cash as a result of the collapse of Lehman Brothers flowed into equities after the Fed started QE. You don't have that same force behind the dollar this time around. So it's possible that the dollar will not weaken as much, but it will certainly trade with a weaker tone after that second round of QE. Again, I reiterate that in an era of stagnation, when economies are stagnating and we're seeking new trend rates of growth, everyone wants a devaluation, and we're going to continue to see that.
And if I can ask you, Stephen, about the prospects for the yen, I think right now it's trading near a 5-week low against the euro, a weekly loss against all its major counterparts. Will it continue to weaken?
I think that the yen will probably find a little bit more downside versus the dollar in the very near term as a result of this massive, large-scale intervention that the Japanese went ahead and did. But I think ultimately the dollar will trade to lower levels versus the yen in the next 6 to 9 months. The Japanese will probably be a force in the market, though, to try and prevent that yen from strengthening aggressively. But ultimately, I think we will see lower levels in dollar-yen in the next 6 to 9 months.
Stephen Gallo, head of market analysis at Schneider Foreign Exchange, thank you so much.